If you truly understand the U.S. tax code, commercial real estate becomes one of the most tax-advantaged investments in America. I'm not talking about loopholes. I'm not talking about gray area strategies. I'm talking about completely legal frameworks built directly into the tax code that allows investors to generate large paper losses, offset income, defer capital gains, reduce a tax drag on compounding, and sometimes defer taxes for decades. In this video, I'm breaking down the most powerful tax strategies available to commercial real estate investors, whether you're a passive LP or an active operator running your own deals. This is the ultimate CRE tax hacks guide. Let's get into it. First, we have to understand something fundamental. The tax code incentivizes real estate. Why? Because real estate creates housing, it creates jobs, it drives development, it stimulates local economies. So the government rewards capital that flows into real estate. Real estate isn't powerful because it avoids taxes. It's powerful because it defers them, it reclassifies them, and strategically times them. Now let's talk about specifics. 1. Depreciation, the engine. Every commercial real estate investor benefits from depreciation. When you buy commercial property, the IRS allows you to depreciate the structure over 39 years. Land does not depreciate. The building does. Let's say you buy a $10 million property. $8 million is allocated to the building. That's roughly $205,000 per year in depreciation. Even if the property generates $400,000 in cash flow, you might only show about half of that as taxable income after depreciation. And that's before interest deductions. That's layer one, but here's where it gets powerful. Number 2, cost segregation and accelerated depreciation. This is the heavy artillery. Instead of depreciating everything over 39 years, a cost segregation study breaks the property into components. Some items qualify as 5-year property, 7-year property, 15-year property. Things like carpets, appliances, certain electrical systems, and land improvements like parking lots can be depreciated much faster. Now layer in bonus depreciation. Depending on current law, a percentage of those shorter life assets can be depreciated immediately. Here's a simplified example. You buy a $10 million building. A cost segregation study identifies $3 million as shorter life property. That could generate over $1 million in first-year depreciation. Now let's separate who benefits. For passive LPs, if you invest in syndications and receive a K1 with a large paper loss, that loss can offset passive income. If you don't have passive income, it may be suspended and carried forward. And those suspended losses often release when the property is sold. So even if you don't benefit immediately, it still has long-term value. For active operators, if you qualify as a real estate professional and materially participate, those losses may offset ordinary income. That's how some operators show large real estate losses while running profitable businesses. But this requires meeting strict IRS tests for time and participation. Documentation matters. This is not casual. Another thing to be aware of, accelerated depreciation reduces your basis, which means that when you sell, some of that depreciation may be recaptured unless you defer it, which brings us to exits. Number 3, repairs versus improvements. Massively overlooked issue. The IRS requires improvements to be capitalized, but repairs and routine maintenance may be expensed immediately. That difference can swing your tax bill dramatically. For example, you spend $500,000 renovating a property. If it's classified entirely as an improvement, you can depreciate that over 39 years or about $12,800 per year in deduction. But if $200,000 qualifies as repair under tangible property rules, that $200,000 may be deducted immediately. It's a huge difference. There are also elections like the de minimis safe harbor, routine maintenance safe harbor, and partial disposition rules. For example, if you replace a roof, you may be able to write off the remaining basis of the old roof. Most investors either overcapitalize and overpay taxes or overexpense and increase audit risk. The advantage comes from knowing the rules and applying them correctly. Number 4, passive versus active status. This is one of the biggest dividing lines in tax outcomes. Passive LPs, where rental activity is generally passive. Passive losses, they offset passive income, and the excess gets suspended, and suspended losses may release upon sale. So if you're an LP and you see big paper losses but don't feel immediate benefit, that's normal. They may still be available later. Active operators. If you qualify as a real estate professional and materially participate, rental losses can become non-passive. That means they may offset W-2 income or business income and other ordinary income. But again, there are strict hour requirements and material participation tests. This is strategic planning territory. Number 5, interest deduction strategy, section 163J. If you use significant leverage, there's another layer. There is a limitation on business interest deductions. Real estate businesses can't elect to be an electing real property trade or business in order to avoid that limitation. But that election requires using slower depreciation on certain property. So now you got to choose unlimited interest deduction or faster depreciation. There's no universal right answer. It depends on leverage, hold period, and long-term strategy. Number 6, exit strategies. This is where wealth compounds. 1031 exchanges. Here's where you sell your investment property, you reinvest into a like-kind property and defer capital gains and depreciation recapture. However, the rules are strict. You have 45 days to identify, 180 days to close, and you must use a qualified intermediary. But when executed properly, this allows investors to scale portfolios without triggering taxes at each sale. You have installment sales. If you sell or finance a property, you may spread gain recognition over multiple years. That can smooth income and reduce tax spikes. Opportunity zones. If you have large capital gains, reinvesting into qualified opportunity funds may allow deferral and potential additional benefits, but compliance is complex and requires professional guidance. 7, advanced partnership strategy, section 754. For syndicators and GPs, a section 754 election can create inside basis adjustments when partnership interests change hands. That can increase depreciation for incoming investors and align tax economics. It adds complexity, but in structured deals, it can be powerful. Number 8, energy incentives, section 179D. If you're improving energy efficiency in commercial buildings, you may qualify for additional deductions. This is especially relevant for large value-add projects. Certification is required, but worth evaluating. The CRE tax flywheel looks like this: acquire, cost segregate, optimize expenses, leverage strategically, defer via 1031, and then repeat. Commercial real estate isn't about avoiding taxes. It's about timing them, designing around them, and compounding more capital because of that flexibility. If you found this valuable and you want more deep dives like this on commercial real estate, investing, and capital strategy, make sure you like the video, subscribe to the channel, and drop a comment below with what topic you want us to break down next. Also, if you're serious about becoming a smarter real estate investor, check out some of our previous videos on the channel and visit our learning center on our website, rockstep.com. Thanks for watching, and I'll see you in the next one.